Death and taxes in Canada. What you need to know about terminal tax returns. They say the only two certainties in life are death and taxes. But what happens when they both arrive at the same time? In Canada, the tax implications when someone passes away can be complex. But with the right planning, they could also present opportunities to reduce taxes and preserve more wealth for your beneficiaries. Today, we're going to walk through what happens from a tax perspective when someone dies in Canada, and how filing multiple tax returns in the year of death can help optimize the outcome for the estate. Welcome to the channel. My name is Anthony Gismondi. I'm a Senior Wealth Advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, make sure to subscribe and click the like button. Let's talk about death, taxes, and how smart planning can make a big difference for your loved ones. Why planning ahead matters. When someone passes away, their final tax return, often called the terminal return or date of death return, must be filed. But in some cases, the executor can file multiple returns for the year of death, depending on the type of income received by the deceased taxpayer. Why does this matter? Because Canada uses a marginal tax rate system. The more income reported on a single return, the higher the tax rate. But if that income can be spread across multiple returns, each return gets its own set of marginal tax brackets and certain credits, potentially lowering the overall tax bill for the year of death. This can mean more money left in the estate for beneficiaries. Filing multiple returns. The basics. In the year of death, there could be as many as 4 separate tax returns filed for the deceased, depending on the circumstances. These could include 1. The mandatory T1 income tax and benefit return, often called the terminal or date of death return. 2. A rights or things return. 3. A return for income from a partnership or sole proprietorship. And 4. A return for income received from a graduated rate estate or GRE. Each of these returns is assessed separately, which means separate marginal tax brackets, separate access to certain credits like the basic personal amount, potential for significant tax savings. Let's break down each one. The mandatory return, T1 income tax and benefit return. This is the standard return that must be filed for every deceased taxpayer. It's often called the date of death or terminal return. It includes all income earned from January 1 up to the date of death, any capital gains and losses triggered by the deemed disposition of assets at death. Due dates for the return depend on when the person passed away. If death occurred between January 1st and October 31st, the return is due on April 30th of the following year. If death occurred between November 1st and December 31st, the return is due 6 months after the date of death. Elective return, rights or things return. This return covers income that was earned but not yet received at the time of death, what the CRA calls rights or things. Examples include unpaid salary, commissions or bonuses, declared but unpaid dividends, unused vacation pay or sick pay, unpaid CPP, OAS, or EI benefits. This return must be elected and filed separately. The deadline is the later of 1 year after the date of death or 90 days after the date on the notice of assessment for the terminal return. Elective return, which is the business or partnership income return. If the deceased was a sole proprietor or partner in a business that doesn't use a calendar year end, some of that business income may be eligible for a separate return. Example, taxpayer dies on September the 1st. Their business has a fiscal year end of January 31st. Income earned from February 1st to September 1st can be reported on a separate return. This return is due on the same date as the terminal return. Another elective return is the graduated rate estate, or GRE income return. If the deceased was a beneficiary of a graduated rate estate that does not use a calendar year end, any income or capital gains distributed from that graduated rate estate may be reported on a separate return. This allows for further planning flexibility. Like the return for business or partnership income, this GRE return is due on the same date as the terminal return. Why file multiple returns? Each additional return gives you access to a set of new marginal tax brackets, additional basic personal amount credits. This can significantly reduce the overall tax burden on the estate, leaving more for your beneficiaries. But it's not always the right move. Filing multiple returns adds complexity, may increase professional fees, and can delay the state administration. That's why it's critical to work with a qualified tax advisor to determine whether it's worth it in your situation. Death and taxes may be inevitable, but with the right planning, you can make sure your estate is handled efficiently and your loved ones are taken care of. If you're an executor, a beneficiary, or just planning ahead, understanding how terminal tax returns work is a key part of smart estate planning. If you found this video helpful, give it a like, subscribe to the channel, and drop a comment if you have questions about estate taxes or filing multiple returns in a year of death. Thanks for watching, and I'll see you in the next video.